Peter Rose, Longwood Currency Trading. I had a couple of questions over the last 4 or 5 weeks or so, because I've been talking about some issues in staging. And the question has to do with the relationship between the average price resulting from the staging and the current price. And I guess there's some misunderstanding or some clarification that folks would like to have as to what I'm talking about as to average price and its proximity to the current price. When you have a position on, let's say you're trading one lot, and you're trading, you entered the position at 1.1010, all right? And so your average price, because there's only one lot, is 1.1010. If I stage another lot in at 1.1020, then I've got an average price between those two, between 10 and 20, which would be, right, 15. So your average price is 15, and your current price is 20. Let's go back. I'm going to cover it again. I entered the trade with one lot at 1.1010. Okay? And so I've entered the lot at that point, 1.1010. So my average price is 1.1010, and the current price is 1.1010. All right? So you're basically in a negative position when you enter that trade because of the VIG, because of the spread. 1.5, 1.2 pips, whatever it is, 5 pips. It depends on the currency pair that you're trading. If you're trading the majors, you can get those spreads at 1.5, 1.25 pips. So you're, say, 2/3 of a pip on either side of that. That's your differential. And you have to be aware that the spread contributes to the average price and the current price. As soon as you enter the trade, you're underwater by, let's say, a pip, 1 pip, just to make things easier. Okay, two pip spread, you're underwater by a pip. If you close that trade right away, you're going to lose the 2 pips on the spread because the difference is there, okay? Hopefully you understand that simple relationship between current price and the spread. Removing the spread from the calculation, we're looking at entering a trade at 1.1010. The current price is 1.1010. You have no profit. You have a little bit of loss on the spread. It's not going to consider that. But that's also the average price because you've only got one lot on. Price goes to 1.1020. It's moved 10 pips up. Okay? So my current price is 1.1020, but the average position price that I have is 1.1010. So I've got a 10 pip profit. So the question is, do you get out there and make the 10 pip profit, or your confidence in the movement upward is high, so you enter another lot at 1.1020. So you've got a lot at 1.1020, 20 pips above 0 or 10 pips above the original one. So if price went to 1.1015, that's the average price, so only 5 pips, you'd be at a break-even point, because that's what the average price means, right? If you take 1 pip at 1.1020 and you take another trade at 1.1020, and you have an initial trade at 1.1010, you have two pips, two lots on at 10 pips apart. You got to add them together and average them, and it's 1.1015 is your average price. When you put that last lot on at 1.1020, that was the current price. Your average has been brought up from 1.1010, okay? You add another one, the average price has been brought up to 1.1015. You're 5 pips away. Your average price is 5 pips away from the current price. If the current price was to go to 1.1025, you'd be 10 pips. The current price would be 10 pips away from the average price, right? Okay. So where's the danger there? What's the concern that I'm expressing? You have the same situation that you have when you enter the initial trade right away. I go in at 1.1010 with one lot. The average price is 1.1. I have no profit. I have nothing. If price goes down to 1.1009, I've lost a pip. All it has to do is move up 1 pip, and I'm underwater. If price goes up and it goes to 1.1020, and the average price comes up to 1.1015, and price now drops from 1.1020 to 1.1019, then I've lost 1 pip on that second lot, but I've gained 9 pips on the first lot, but the average price is 1.1015, so the difference between 15 and 19 is 4 pips. I have 4 pips of profit. So the closer that average value is to the current price, the less likely you are going to have any kind of profit at all when you stage, because of the spread, because price always retracts back. It moves up a little bit and it moves down a little bit, and it moves up a little bit more and it comes down a little bit more. So you always have that variation. If you get your momentum right, which is the key to the whole thing, then that price as you stage into it is going to continue to go up. And so your current price goes up and your average price goes like this. You notice the average price will catch up to your current price if you stage in incorrectly. That's why what you want to have happen is that the average price is here, and you start to stage in, and as you stage, this is what happens, is that your average price lags behind the current price by a distance sufficient to withstand whatever you feel is a comfortable retracement and still hanging on to the position. You're going to be running a stop behind that current price. If you run it too close, then you'll get stopped out, you'll get a profit, but you're missing the point of the trade and in your staging. That's why staging is a complex process. It's not meant to be done by beginners or somebody with less than a couple of hundred trades or somebody less than a couple of years of trading. I mean, I'm just being serious about this stuff, because you see all these people out there teaching these exotic methodologies of trading, staging and compounding and reverse ads and negative staging, all this stuff, and you can't. The person doesn't even know how to really trade. How do you trade? You know how you trade? I was in real estate for 40 years. Now I've held buildings for 20 and 30 years. That's a long-term trade, but I understand trading, right? And the longer that you hold and the price appreciates, the more money that you make. That's great in real estate. In currency trading, not so great, because you have the economic conditions and requirements of the two disparate pair of countries that you're dealing with. One country says, I'm not going to buy this currency over this value, and the other one says, well, we're not going to sell it below this value. And so you have this constant struggle. That's why you see range bounds. When you see these big, long ranges, the economies are exchanging their currencies at an agreed-to spread. Huge, billions and trillions of dollars. I mean, the currency market is $7 trillion a day. You can't even conceive of that. And as retail traders, we're only 15% of that. It's the big institutional traders that are the dog in this. And they're the ones that are executing the economic orders between the pair countries. I got a big manufacturer over here, and they want to buy this country's dollars so they can sell their dollars and make the exchange of their manufactured goods. It has nothing to do with Fibonacci and all this other shit that people are talking about. Fibonacci is for rings on trees and population growth of insects, but not for currency trading. That's voodoo. And you can after the fact, you can say, oh, this hit the 68 point something fib line, and so therefore it respected that resistance. No, it didn't. It just got lucky and it hit that point, because those points are I mean, I can draw random lines on a chart, and you go, oh, well, see how that's respected that level. It didn't respect the level. The order flow is what creates price action. And because of that, we have such tremendous advantage in the currency trading as opposed to stock trading or options trading or commodities trading. I mean, Bob at company ABC could be bilking the company on crummy accounting for hundreds of thousands of dollars or billions of dollars a year. You don't know. And all of a sudden it comes out that happened, or somebody's overstated earnings. I think it was Groupon overstated the earnings by twice because they were counting the earnings as the amount that the person paid for the Groupon coupon. But they only got half of it, or a small portion of it. But they were counting all that as earned income. Their stock, oh, this company's doing great. The stock went up. All of a sudden, the guy came and go, oh, no, we don't keep the whole premium. Our earned income is different than our net profit or our base profit, which is, guess what, 50% below where it was. The stock went, boom. Is that the environment you want to be in? You know, you see these large movements in the currency market, these 15-minute bars that usually have maybe on some of the currency pairs might have let's say they have a 7 to 10 pip range, and you'll see them go to 20 or 30 pips. The bar goes up. Sometimes it'll pin bar out, but a lot of times you get a solid bar. You just go, well, isn't that cheating? No, that's a country that says, or a manufacturer that says, I'm willing to buy this up to here, but I can see that it's going to go beyond that, so I got to get my buying in now. Or there's an institutional broker that says, my guy isn't going to want to pay any more than where the current price is. In other words, I can't make any money making trades for this manufacturer because he isn't going to spend any more money than this. So guess what? I'll run the price up with a couple of $100 million order. All the retail traders will pile in and buy, and then I'll just sell the shit out of it. I'll catch all their stops, and we'll settle it down here. That's the only way you get liquidity in the market and to be able to function as a large institutional trader. And you're going to see these large candles happening more because when I started, it was, I think the currency market was $3 trillion a day. It's $7 trillion a day now. So as you get more and more trillions of dollars involved in the market, the 15% of that retail market is more and more dollar value. we're targets for the big institutional traders. So you're going to have these big bars where the institutional traders are just pouring hundreds of millions of dollars into the trade to get the price, and then boom, down it comes. Or go the other way. You just sell the crap out of it and then buy it back. All they're doing is executing things that are for sale and selling stuff that's overpriced. It's economics. They're not stop-hunting you. They don't care about you. All they know is their guy isn't going to pay more than this, and they're not going to sell their product for less than this. And that's the range that they have to work in. And so if you're going to stage into that, you have to be aware of what the economics are behind what's going to happen to that price after you put your stage point in. What's the momentum that the price has? That's why I harp on this thing. If you're going to stage, if you're advanced enough listening to this channel where you are and you have a large enough account, I mean, oh, come on, man, don't be taking 3 mini accounts and start staging micro lots in. You're just wasting your time. You're wasting your time. But if you've got a solid 5-figure account and you are starting to stage your money, that's what I'm trying to help you with. I'm particularly geared my channel for the 4-figure and low 5-figure account traders who are trying to get the skills necessary in order to trade account sizes that are large enough to replace your day job. That's what we all want to do. Oh, well, I don't want to do that because I don't have a day job. I'm retired. I made a lot of money doing my real estate and as a software engineer. I'm retired. I'm done with that. I don't need to replace my day job income. You know, I'm 73 years old, so why do I need to build my wealth? I don't need to build my wealth. I'm fine. I'm going to make it. But an extra $70, $100, $200,000 a year, whatever it ends up being that I can make, $20,000 a year, doesn't really make any difference, but that's all going to help. You know, my Social Security is probably, I think I'm something like $2,600 a month or something like that. The average is around $1,300. So I'm doing really well from my Social Security, but I was a software engineer for a long time, 33 years. So I made good income. But if you could make, so let's say it's $26,000 a year, $25,000 a year. So if I could make $25,000 a year, I'd be making my Social Security. I'd be doubling my Social Security. I wouldn't even have to draw off any of my other investments or whatever. And then you get out and you appreciate the life. That's what you're making the money for, to appreciate your life. Don't be in such a scramble to replace your day job income. Concentrate on consistent earnings. And if you're going to start staging, you're going to have to really be concerned and knowledgeable about the price differential between current price and your average stage price. And you're going to have to know a little bit about the economics of currency trading, so that you don't get surprised by these large candles, that you're prepared, that you have rules in place in order to deal with the anomalies that are going to happen. Because of the size that I carry, well, I'm in a position now. One of those candles just popped up, and it was really large. It went against me, but it didn't go that many pips, but it was $7,000. Of negative result for me in the current trade. But it wasn't that many pips. What am I going to do? I'm going to get out? I'm going to get out? I let it go another 7,000 because of the size of the position that I have. It's small. But I can do that because I have a 6-figure account, a solid 6-figure account. If you're dealing with I don't know, $30,000, $50,000 or something, trading reasonable leverage, you know, so that you're trading 3 to 6 pips or something like that. I mean, this 200 to 1 leverage is crazy. I mean, somebody tells me they're trading 200 to 1, they want my advice. I say, stop trading at 200 to 1, call me back, because I just, you will end up losing all your money, and I don't want to be part of that. But if you're at that point where you are ready to start thinking about staging, then these are the things that you really need to be concerned with. If you're not there yet, admit to the fact that you're not there yet and you're still learning your skills. I can help you with that. I can help you if you're trading six figures. I can, because I'm going through that now. The start of the year, I was trading three full lots. Then I moved 3 to 6 full lots. Then I was trading 6 to 8, and then 8 to 12, I think it was, and the last month or so I've been making trades 15, 20 lots at a pop. I've done several at 25 lots a pop, and I'm not trading 200 to 1. The differential between that current price and the average price is an issue that you really need to actively manage if you're in it. And if you're in a situation with an account size where you're not ready to start staging, you need to be diligent about awareness of where your price is, where your enter price is, because you're going all in and you're coming all out. Where is your price in relationship to the current price? You can't just say, "Oh, I made $100. I made $50. I'm doing really." That's bullshit. That's what you see all these other people that are teaching out there. "Oh, you made $50." No, you can't think of it that way. When I work with somebody, we got to start right from the base and build our way up. Look, I've been involved in teaching the martial arts now for well over 50 years. I know how to put a curriculum together. I know how to teach. And I look at what these people are doing out there, and they're doing you a disservice. You won't get any better education paying $1,000 for your coursework than you would if you went to Udemy and paid $49.95 for their course, 16 modules and all the shit that you can take, because they're not really teaching you anything. It's like a dictionary. This is a pip, and this is how you size your bank, and this is a Fibonacci level. That's a bullshit. It's bullshit. But you do what you need to do. You do with the best that you're capable of dealing with. I'm just saying, don't pay any attention to this stuff. Learn the mechanics and figure the rest out for yourself. And if you can't figure it out or you're having trouble, that's where someone like myself might come into play. Where you're trading and you're not having the success that you have, you're an intelligent person, you want to work and you want to get it, and you're willing to spend the time and the effort and the money to get it right. Because even though you may be trading 3 mini lots or 1 full lot, if you can get this down and get the consistency in that trading and learn the skills in an organized, progressive manner, you could sell your car and get all the money together and get yourself a $30,000, $50,000 account, and you could start making some considerable gains on replacing that day job income. And if you can't replace the day job income, let's say you're making $60,000 or $70,000 a year, but your trading is only giving you $20,000 a year. Jesus, do you know if you put that $20,000 back into you take that money and then you start compounding that. The first year you trade 1 full lot, you make 30%. Oh, okay. So you've got $3,000 on your $10,000 that you had put in there to trade the full lot. So you got $3,000 more. In another year, you'll have 6, and you could just scoot by on the margin level and trade 2. But you have to be very careful about that. What happens if you have $30,000 or $40,000 in your account and you do the same thing? You make 30% against a $40,000 account, that's $12,000 a year. That's another lot. Now you're trading a $50,000 account. You can't do that when you're down trading minis and in the low 5 figures, because there's other things that you need to concern yourself with. As you get more experience and you trade with more money, you can do different things. But just because you have experience trading a 4 or low 5 figure account doesn't mean that you can do those other things. Because the other things that I talk about, this is what I teach, those other things require the money to do them, to take advantage of it. All you're doing by trying to do that in the lower account sizes is you're taking on more risk. And so when you fail with that, you say, oh, the system is wrong. You listen to these people out there, you buy their systems and stuff. Oh, it didn't work, so I'll buy somebody else's system and I'll go and I'll do that. Jeez, you do that 3 or 4 times, 5 times, you'll spend, probably won't spend as much as you would if you spent with me, but how much aggravation and grief are you going to go through? I mean, you know, if you want to be a doctor, you got to figure you're going to come out of there with a couple $100,000 of debt. But you're going to have an income to pay that off. Well, you're going to have to spend the money to get the proper skills. So if you expect to make $60,000 a year out of your trading, don't think you're going to do that on a $20,000 account. Okay? Let's just be realistic about it. However, why should that bother you? You're in the 21 to 34-year-old age group probably. You've got 30 years to figure this stuff out. You know, I have a hard time when I'm working with the folks that are at the 50-year-old and up age group, because they've gone through their career. And if they haven't saved enough money by that time, they're running scared. And it's very difficult for them to think that currency trading could be a potential solution for them. You know, I'm working with a few folks right now, not in consulting or mentoring, because they don't have enough faith in themselves because of all the bullshit that they see out there that they're exposed to, that spending money for education is going to give them the skills and that they'll have the time in order to execute those skills. That's why when I work with a 50-year-old, it's going to be totally different than if I work with a 21 to 34-year-old. If you're 21 to 34 years old, you've got the time, and we can really work through this stuff, because you'll be able to make $1 million with this stuff. The guy that's 50 years old, he ain't going to make $1 million, but if he could make an extra $20,000, $30,000 a year, that's going to be huge. Or if he's 50 years old, he's been successful in, for example, myself in real estate, or he's going to be retiring on a pension from the police department or something like that. Being able to make $20,000 or $30,000 or $40,000 a year more, that's just going to be wonderful. And if they happen to have a large amount of savings and they get their stuff together and they start trading a $200,000 or $300,000 account, even if you make 30% against the $300,000 account, that's $90,000 a year. Come on. You can make as much money as you've got money and skill to go with that. And one of the things, as you increase in your lot size, that you're going to have to be very well aware of is this differential between where your current price is and where your average price is. And to support that is going to be that position management phase of the life cycle of a currency trade, right? You got entry analysis, position management, and exit methodology. So in that position management phase of that life cycle, as that position is maturing through in profit, you have to manage that so that you don't lose that profit, so that and the only way you're going to lose that profit is you do something stupid, you don't recognize the signs when it's time to get out, you don't have rules of engagement for staging and exiting and all that other stuff. If you're in an educational program and you're not learning the methodologies of dealing with all this stuff with an all-in, all-out process, you're never going to be able to learn how to do this once you start staging and you're doing your averaging. It's not going to work. And believe me, I understand that. I've got a degree in physics. I've got almost a minor in math. 33-year career as a software engineer. 40 years, as I said, as a real estate investor, and over 50 years in martial arts. I've been around the corner before. I understand risk management. And that's why I've gone from trading a $30,000 account to mid-six figures, or a low six-figure account. Because I've got the confidence and I have the skill in order to do that. I've got the skill to be able to sit here and look at my screen and say, well, I mean, I just lost another, $7,000, and then sit here and, 5 minutes later, it's, oh, well, I'm 2,000 to the good. It's nothing special. This stuff is so simple. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.